Hello everyone, I'm Yali Zhang. Silver just dropped $0.50 in a single session. Gold fell $10. And if you think this is just another routine pullback, you need to understand what's actually driving these metals right now. Because the pressure building beneath this market tells a very different story than the headlines suggest. We're watching profit taking, yes, but we're also watching something much larger take shape in the structure of precious metals demand, something that connects industrial consumption, monetary policy expectations, and a fundamental repricing of risk that most investors still haven't fully grasped. Before we go further, subscribe right now because what you're about to hear explains a shift most investors still haven't noticed. A shift that's rewriting the rules for how silver and gold respond to economic data and why the next few days could clarify where this market is actually headed. Let me walk you through the numbers because they matter more than the surface explanation suggests. April gold closed down $10 at $5,069 per ounce. March silver fell 51 cents to 81.75. Those are significant moves in percentage terms, especially for silver, which dropped more than 0.5% while gold barely moved a fifth of that. This divergence matters. Silver is leading to the downside, and when silver leads in either direction, it's telling you something about risk appetite, about industrial expectations, and about how traders are positioning for volatility. The official explanation is profit taking. Traders locking in gains after recent rebounds. That's true as far as it goes, but it's incomplete. Yes, shorter-term futures, traders are taking chips off the table. Yes, there's position evening ahead of critical economic data. But look closely at the context. We're not just waiting for any jobs report. We're waiting for the January employment figures that include the annual benchmark revision to payroll counts. A revision that Bloomberg says is expected to reveal a notable markdown to jobs growth through March 2025. That's not minor technical adjustment. That's a reassessment of how strong the labor market actually was during a critical period when the Federal Reserve was making rate decisions based on employment strength. Now notice what changed in the data calendar. The jobs report hits Wednesday. The Consumer Price Index comes Friday. These releases are unusually close together because the partial government shutdown delayed both by several days. What this creates is a compressed information window where the market gets labor data and inflation data within 48 hours. Traders don't like compressed information windows when they're holding leveraged positions in volatile assets. They reduce exposure. They flatten books. They wait to see what the numbers actually say before committing capital. That's the mechanical explanation for today's selling pressure, and it's rational. But here's where it becomes important. The forecasts themselves reveal the tension in this market. Economists expect payrolls rose 69,000 in January. The unemployment rate is projected to hold at 4.4%, near a four-year high. On the inflation side, the core consumer price index, which excludes food and energy, is expected to rise at the slowest annual pace since early 2021. Think about what that combination means. Weak job growth, elevated unemployment, slowing inflation. In a normal cycle, that's a setup for rate cuts. It's a setup for dollar weakness. It's a setup for precious metal strength. And yet, silver is selling off ahead of data that should theoretically support it. This tells you something about positioning. It tells you the market ran too far, too fast, and now it's correcting not because the fundamental thesis changed, but because the timing got ahead of reality. Silver hit $82. Gold pushed past 5,000. Those are psychological levels, round numbers where resistance naturally forms. When you combine round number resistance with event risk from major economic releases, you get exactly what we're seeing today. Profit taking, de-risking, waiting. But let's talk about what hasn't changed, because the structural story in silver remains intact. Industrial demand for silver continues to grow, driven primarily by solar panel production and electronics manufacturing. The solar sector alone is consuming record quantities of silver, and that demand is price inelastic in the short term because manufacturers can't easily substitute away from silver without redesigning entire production processes. Meanwhile, mining supply remains constrained. Most silver comes as a byproduct of copper, lead, and zinc mining, which means silver production doesn't respond quickly to price signals. You can't just open a pure silver mine overnight. The supply curve is sticky. Now layer in the ETF flows. Silver-backed exchange-traded funds saw sustained inflows over the past several weeks as investors positioned for potential currency debasement and inflation persistence. Those flows represent long-term holders, not traders. They represent portfolio allocators who are buying silver as an inflation hedge and a monetary alternative. That capital doesn't leave quickly. It doesn't react to single-day moves or profit-taking pressure. It sits there, creating a bid under the market that prevents the kind of collapse you'd see if this were purely speculative froth. Look closely at the dollar correlation, because it's critical right now. The US dollar index is slightly down today, which in theory should support precious metals prices. The inverse correlation between the dollar and metals is one of the most reliable relationships in commodity markets. When the dollar weakens, gold and silver typically rise because they become cheaper for foreign buyers, and because dollar weakness often signals concerns about U.S. monetary policy or fiscal sustainability. Today, that correlation isn't working cleanly. The dollar is weak, but silver is weaker. That's a sign of technical selling overwhelming fundamental support, and it's exactly the kind of price action you see before a trend resumes in the original direction. Interest rate expectations are shifting beneath the surface of this market. The 10-year Treasury yield is trading at 4.145%. That's elevated by historical standards, but it's come down from recent highs as inflation data has softened and as the jobs market has shown signs of cooling. Lower yields reduce the opportunity cost of holding non-yielding assets like gold and silver. They make precious metals more attractive relative to bonds, and yet we're seeing selling pressure today. Again, this points to event risk, to position squaring, to traders stepping aside before major data releases rather than a fundamental reassessment of the metal's value. The gold-silver ratio is worth watching here because it reveals the relative strength between these two markets. When silver falls harder than gold, the ratio rises, meaning it takes more ounces of silver to buy 1 ounce of gold. A rising ratio typically indicates one of two things. Either industrial demand expectations are weakening, or risk appetite is declining, and investors are rotating from the more volatile silver into the safer gold. Right now, given the broader context, it looks more like the second explanation. Traders are de-risking ahead of data. They're moving out of the higher beta metal and into the lower beta one. That's a temporary positioning dynamic, not a structural shift in demand. But here's where it becomes important. This pattern has appeared before. Go back to previous cycles where the market was waiting for critical employment and inflation data. You see the same thing. Metals sell off in the days before the releases as traders reduce exposure. Then, depending on what the data shows, you either get a sharp reversal if the numbers support the bull case, or you get an extension of the decline if the numbers undercut it. We're in that waiting period right now. The price action over the next 72 hours will tell us whether this is a healthy correction within an uptrend or the beginning of something more sustained to the downside. Now, let me shift to what this actually means, because the numbers only matter if you understand the implications. If the jobs data on Wednesday comes in weaker than expected, if that benchmark revision shows significantly fewer jobs were created than previously reported, that's a signal the economy was softer than the Federal Reserve thought when it was making policy decisions. That increases the probability of rate cuts. It increases the probability the Fed pivots sooner rather than later. And that is fundamentally bullish for precious metals because it means easier monetary policy, more currency in circulation, and higher inflation risk over time. If the CPI data on Friday shows inflation continuing to slow, that gives the Fed room to cut rates without worrying about reigniting price pressures. Again, that's bullish for metals. Lower rates, weaker dollar, higher gold and silver prices. The fundamental setup favors the bulls. What we're seeing today is not a rejection of that setup. It's a tactical retreat before the data confirms or denies the thesis. But there's something deeper happening here, something about currency confidence. Silver and gold aren't just commodities, they're monetary metals. They're alternatives to fiat currency. When investors buy silver at $82 an ounce, they're making a statement about what they think paper currency is worth, or more precisely, what they think it might be worth in the future. The fact that silver rallied as hard as it did before this pullback tells you there's real concern out there about fiscal sustainability, about central bank policy, about the long-term purchasing power of the dollar. This isn't about conspiracy, it's about math. The US is running massive fiscal deficits. The national debt continues to grow. The Federal Reserve expanded its balance sheet dramatically, and while it's reduced its sum, the money supply is still elevated compared to pre-pandemic levels. That's the environment where hard assets like silver and gold tend to perform well, not because of manipulation or secret schemes, but because investors rationally seek stores of value that governments can't print. Today's selling pressure doesn't change that calculus. It just creates a better entry point for people who understand the long-term trajectory. Investment psychology matters here too. Markets don't move in straight lines. Even the strongest bull markets correct. Even the most compelling fundamental stories experience pullbacks when positioning gets crowded and when event risk creates uncertainty. What separates successful investors from unsuccessful ones isn't the ability to avoid corrections. It's the ability to distinguish between corrections within a trend and trend reversals. Right now, the evidence suggests this is the former, not the latter. The structure of demand hasn't changed. The supply constraints haven't eased. The monetary policy environment still favors hard assets. What's changed is short-term positioning and near-term uncertainty about data releases. Here's what you need to understand going forward. Silver's role in the global economy is changing. It's no longer just an industrial metal that moves with manufacturing cycles. It's becoming a hybrid asset, part industrial commodity, part monetary alternative, part technology input for the energy transition. That creates a more complex demand profile, but it also creates more durable support under the price because you're not relying on a single source of demand. Even if industrial demand softens, investment demand can pick up the slack. Even if ETF flows slow, solar demand continues growing. The long-term implications for investors are significant. If you believe the energy transition continues, you have to believe silver demand continues growing because there's no viable alternative for solar panel production at scale. If you believe central banks will remain accommodative over time, you have to believe precious metals maintain their appeal as inflation hedges. If you believe fiscal deficits and debt levels create long-term currency risk, you have to believe monetary metals like silver and gold will be part of a diversified portfolio strategy. Today's pullback doesn't change any of those beliefs. It just tests your conviction. The next 72 hours will clarify where this market is headed in the short term. Watch the jobs data Wednesday, watch the CPI Friday. Watch how silver and gold respond to those releases. If the data comes in weak and metals rally, that confirms the bull thesis and suggests this was just a tactical shakeout. If the data comes in strong and metals continue falling, that suggests the market needs to reprice expectations, and we could see a deeper correction before the next leg higher begins. Thanks for watching. Subscribe, share this, and stay alert. Because what's happening in the silver market right now matters more than most people realize. This isn't just about daily price moves or trader positioning. It's about a fundamental reassessment of value, risk, and what assets you want to own when uncertainty rises and currency confidence falls. The story isn't over, it's just entering a new chapter. And the investors who understand that will be the ones positioned correctly when clarity returns.